building business is really tough.
If you don't actually do it, then that is like a pretty negative signal.
I think that we, in 2021, forgot that building a business was really tough. What I ended up doing was taking all of my psychosis and all of my anxiety and all of my concerns and bringing them over to
what that was like during that transition in 2022.
But that's slow. We have $1.2 billion under management.
Hello, I'm your host, Mike Gelb, and this is the Consumer VC podcast brought to you by Propeller Industries. Propeller Industries is a leading strategic finance and accounting partner for venture stage companies. On this show, we discuss the intersection of venture capital and consumer innovation. And if you're enjoying the show, please like and subscribe on YouTube if you're listening on YouTube, or whichever platform you're viewing this content on. If you're listening on Apple or Spotify, please leave a review as well. If you want to make sure you're in the loop and you want the full experience, you can subscribe to the newsletter at theconsumervc.com, where you'll receive new episodes and weekly updates of all the consumer deals that are happening. All content and episodes are for informational and entertainment purposes only and is not investment advice. Our guest today is Ben Lerer, who is a managing partner at Lerer Hippeau. Lerer Hippeau is a venture capital firm based in New York City who were early investors in Warby Parker, Glossier, and Topicals, for example. He also founded Thrillist. Thrillist is an online media website Ben founded in 2004 and was also the former CEO of Group 9 Media until it was acquired by Vox Media. We discussed that acquisition, actually. That's what we start off with. Why he sold Group 9 Media to Vox. Why he transitioned to VC full-time. And the evolution of New York startup ecosystem. What New York was known for, what it's known for now. And also the goal of when he actually backs a company. Without further ado, here's Ben. Ben, thank you so much for coming on the show. How are you?
I'm well. Thanks for having me.
Really appreciate you taking the time. So last year, you transitioned full-time as a VC. I know obviously you were investing as well. Obviously part of Lerer Hippeau and everything like that, but I believe like you transitioned to investing full time in 2022 after Group 9 Media, which you were obviously the CEO of, sold to Vox. It's a really interesting time to be in VC. What have you, and it kind of like the first, year or two, investing, full time. What was it? Can you talk to me a little bit about like what that was like during that transition in 2022 and how are you seeing the market today?
Yeah, absolutely. Well, it's been sort of a funny ride. So we started Lerer Hippeau in 2009, 2010, and I was building Group 9 and sort of doing two jobs at once for what turned out to be much longer than I expected to do two jobs at once. And I think, interestingly, you had just very consistent growth in sort of like the venture market and the, early stage tech sector for a decade, like an extremely long bull run. And I started my investing at first, hobby and eventually career, I guess, at a time when we were coming out of, sort of like the 2008, 2009 tech blow up. And venture investing was this wonderful distraction from the realities of grinding through being a CEO and an entrepreneur and an operator. And I don't think I fully appreciated what a fun time it was. And it was sort of just this like this other thing that I did. I spent a ton of time on it, but it was in a very favorable market. And when I was eager to sort of get over to investing full time, when I finally, sold Group 9 and made the change, it was at essentially the moment that the sort of, correction was happening or beginning to happen in venture. And so it's been a really, I would say a few things have happened. One is, I sort of had emotionally put my stress in my operating job and VC was this departure and this sort of like creative expression thing for me. What ends up happening, and this is partially how I'm wired, is I make the switch over from being an operator as my sort of like primary day-to-day job, albeit I was super active writing a ton of checks here and co-leading the firm, but it was the other thing. And so what I ended up doing was taking all of my psychosis and all of my anxiety and all of my concerns and bringing them over to the fund, and doing that at a time when the market is more challenging. I think that this is a really healthy and sort of good, I don't know, like when things are too hot, things need to cool down. It's inevitable, and sort of the pendulum swings. I think we're in a really unpleasant and uncomfortable part of the pendulum. And so admittedly, I'm of two minds. On the one hand, I'm doing the job I want to do for the rest of my life. I'm so proud of what we've built here. I love our team. I love our portfolio. I think that we've done a really good job, and I'm so excited for the future. On the other hand, anyone who does not acknowledge that this is a really hard time uh, and a really stressful time to be a venture investor is either very naive or being disingenuous. And so it's been a real transition, and I'm working really hard, and we're really working hard and grinding through this market.
Yeah, I mean, certainly these last couple of years have been very challenging, especially when you compare to it to a low interest rate or zero interest rate environment that we had over the over the last 10-year period from the time before. Why in 2020? I'm just curious. Why in 2022 did you feel like it was the right moment to kind of sell Group Nine?
I don't know. I'm a believer that companies generally get bought, not sold. And so I wasn't running a sale process with Group Nine. I had, I think, built good relationships with the folks who I thought might be natural acquirers. And, a bunch of things were happening in sort of the macro market, and things were happening in our business and in some of our peers' business, where it was a moment where I think consolidation in digital media was inevitable. And there were buyers and there were sellers, and I actually thought that I was buyer. So the conversations that I was in market positioned as a buyer, and and through some of those conversations, it turned out that other people thought they were buyers too, and one of those was Vox, and so I ended up being the seller. But I didn't come into 22 saying I'm going to go sell the company. I came into 22 saying I want to try to create enterprise value. I want to try to build this. And it turned out that, the decision forward was the best path was to build it with Vox versus independently.
Got it. Got it. That makes a lot of sense, and an interesting kind of turn of events there with thinking you were actually a buyer when then you actually turn out to be a seller. So that's great, and that's awesome. Um, and I mean, when I think of obviously like Lerer Hippeau, and I've had a couple of your colleagues on, which has been a lot of fun to host them, and I think Lerer Hippeau, obviously, I have to think about New York and the New York startup ecosystem, and you all were there from like from kind of the beginning, from the startup investing period in New York. And New York was known for back then just because they had many more companies and what have you in consumer. So, and obviously you all were kind of the leaders of that of that kind of moment with obviously Warby Parker, Casper, Everlane, BarkBox. But and obviously, I know Lerer Hippeau is also a generalist firm. You don't just invest in consumer. You do invest in across different categories. But how are you thinking about and I guess when I say consumer and think about consumer, I'm thinking about like inventory based businesses.
Yep.
How are you thinking about investing in inventory based businesses today?
So let me add something right before that, which is our strategy here has always been, and this may sound cliche, and lots of early stage venture investors say the same thing about talent, but like our strategy has been about talent. It's always been about finding people that we think are excellent and are going to build great stuff. And New York, when we got started, 12 years ago in New York, for the first 5, 6, 7 years of the existence of Lerer Hippo, was a market where I think a lot of the best talent wanted to go and build consumer companies. And in particular, a lot of the best talent wanted to go build inventory holding consumer companies. Folks looked at gigantic industries that had been around for a long time, that had large traditional players that had not been disrupted, and there were new advancements in marketing and in supply chain and in a bunch of spaces that made opportunities to build new direct to consumer, product companies very quickly, and so we followed that talent into that category, and I think did a good job doing that. In the last 5 or 6 or 7 years, a lot has changed in terms of the uh, size of the opportunity to go and launch inventory holding consumer businesses. The traditional companies that were ripe for disruption, in some cases, already got disrupted. In other cases, got smarter and became and modernized. Some of the sort of unfair advantage arbitraging moments that existed in various with various acquisition strategies, like when Instagram first turned on advertising, for instance. Those channels got flooded and stopped working as well. Obviously, iOS, 14.5, like broke a lot of the sort of like back end data infrastructure that created some of the really efficient acquisition spending, uh, you know, et cetera, et cetera, et cetera. And so, what we've seen over the last few years is a lot of the best talent that 5, 6, 7, 8, 9, 10 years ago maybe wanted to go and build these sorts of Warby Parker of businesses are now saying this may not be as ripe an opportunity or as great a space. And I think that then gets compounded by the fact that you had a lot of not just early stage investors, but late stage investors pour a ton of money into these businesses that grew really well from 0 to 1 or 1 to 2 or whatever. They got to $20 million or $50 million or $100 million. And then as they got larger, where I think the original thought had been these businesses are going to become better businesses, acquisition got more expensive. Going and being omni-channel led to margin issues. Companies overextended their SKUs and got into inventory problems, blah, blah, blah. And so now where you've netted out is later stage investors, particularly later stage tech investors, are much more risk off in terms of backing these kinds of inventory heavy businesses. And so as an early stage investor, I have to A, go and say, do I think that this is where the best talent is going? And B, who is going to continue to finance these businesses in the future after they get to Series A, B, C, when I know a lot of the folks who had funded the last generation are not going to show up for the next generation. And it's led to a massive slowdown in the number of these companies that are getting started and funded, and also a slowdown in the number of deals that we've done in that space.
Do inventory based businesses, do you find, have the same return profile, for example, from software tech companies, or like the traditional venture model?
There are clearly examples of companies where that has been the case. There have been, real venture returns created by product companies from the last generation and from this generation. I think that they are, by the way, and this is the same for software. I think we were in a world that these businesses were easy to build, and then everyone thought that you could go build any SaaS business, and then that's like the holy grail and easy to, like, everything's hard. Everything is hard, and but the reality is that uh, history has shown that a low percentage of these inventory holding consumer businesses have driven really significant venture returns. Some of them have. We have been one of the funds who's been fortunate to be in a number of those companies. But generally speaking, it's been a hard category, and there's been probably as much death and destruction as there has been real solid returns driven. And so it's just a space to approach cautiously. It is a space that I think we continue to have an unfair advantage in. We know what the profile of these founders looks like. We've been around these businesses and seen, great stories and seen mistakes made that I think we can help people avoid in the future. But broadly speaking, uh, these are, these aren't software margin, tech leverage businesses. They have different dynamics, and so it's harder to drive extreme venture returns.
Yeah, I mean, what I've kind of found with just talking with a number of investors, and is even at the early stage, thinking about like portfolio construction, it might look a little bit different if you're investing in consumer brands versus like technology companies, because with consumer brands, like maybe like the ideal return expectation is maybe like a, let's say, let's call it like a 4 to 6x return, or on investment, which is still really strong, or or an 8x return, and maybe the outcome is in like the hundreds of millions as opposed to the billions, which that's kind of like the ideal outcomes on the tech side.
By the way, that's a great point. I would say that this applies to the market broadly. I think we got into a world where, the sort of like the cliche, like, I don't invest in $1 million companies, I invest in $1 billion companies. Like the idea was early stage VCs coming and going. If it's not $1 billion idea, I don't want to do it. And if you actually look at the history of venture outcomes, the average venture exit for a successful exit is in the $100 million range. Very few companies become $1 billion outcomes. Software or physical product commerce. I do think that rewiring around how do we invest into a business both at entry price and at the amount of total dilution and capital that's going to be brought into this business over time, so that we can drive alpha as a venture fund with 200 and $300 million exits. Like every company is not supposed to be a $1 billion company. Where you get into trouble is when you raise hundreds of millions of dollars for a business to drive a venture outcome. You need to be worth billions of dollars. But what if you can have a model where you can be self-sufficient and still growing nicely, raising, sub $20 million over the lifetime of your business? Well, if you can go sell that business for 200 or $300 million, you can drive great returns.
I know this is like obviously a tough market to talk about this in, but like, how do you when you make an investment, at the seed stage, since I know that that was kind of like the founding of Lerer at that stage, but how do you also like make sure that you're partnering with like the right company, and that kind of like maybe like understands that, hey, like we need to go out and again, this is probably not like the best market to actually say this in, but hey, like if the opportunity sees itself, like maybe it actually might not be the best thing for you to raise like hundreds of millions of dollars. Maybe you go seed, series A, series B, and maybe like that's it, or along your like trajectory.
We have very explicit conversations with folks before, during, and after our sort of courtship and beginning a relationship about this stuff. I mean, one of the first things that we do after we invest in a company during our onboarding, one of the messages that we try to land very clearly is that late stage capital is not your friend. This is not like the lack of alignment of incentives of a series C or D investor relative to a founder is significant. And if we look at the best returns in our portfolio over time, there are outliers, but broadly, it's companies that raised less money and built businesses where they had more control of their own destiny. They got to profitability earlier. They or they, if not profitable, were not companies hemorrhaging cash on their way to try to sort of, have someone pick them off before they ran out of money. The best way to get a good outcome is to have control of your own destiny, right? Is like, if you have to sell, you're probably not going to get the good deal. And so, how do we encourage founders to sort of subscribe to that belief that they're going to need to be capital efficient in their growth? Part of that comes all the way back to the kinds of founders that we pick to work with and that we try to work with. And I would say that we are biasing more towards folks who have been through the rigmarole before, people who are either former founders doing it again, people who have been on the executive team of venture backed stuff that has been high flying, in some cases, high flying and over capitalized and screwed up. Like there's incredible lessons to be learned from being a part of a thing that made mistakes by overcapitalizing themselves. And so, you know, we think that some of those hardships are character building, and we're looking for people who have scars from learning lessons the hard way.
Can you talk a little bit about how the incentives from Series C and Series D investors, for example, are different to the incentives of seed investors?
Yeah, I mean, yeah, I say generally, last money in, first money out much more risk averse, uh, planning for, you know, they want to, they're planning for their, 2 or 3x, uh, and they are, we've seen this an infinite number of times. They invest in a thing, they want to see it working, and be sort of like an outlier in terms of growth for them. If it's not, they lose interest, their last money out, and they just are trying to play defense and make sure they get their money back and can move on to the next one. Uh, that's the late stage investing model, and I think one of the scary things that you sometimes have to just be honest about is, how much do I want a company to work that I put $1 million into? I think for a while, someone who wrote a $50 million check or $100 million check, I naively early in my career was like, oh my God, they want this to work. They need this to work 50 times more than I do. And the reality is their fund is 50 times the size of mine. And, not to say that I don't really want my $1 million check to work, but like part of the business model is that sometimes it works and sometimes it doesn't. And that's part of, and you accept that. And um, I've found that is the reality for these later stage funds. Not everybody, but for many of them, which is, hey, I put $50 million in. It turned out I was wrong. Hopefully I go get my $50 million back as I'm, top of the cap stack, and then I can move on to the next one. Meanwhile, that's a terrible outcome for founders, defensively going to try to repay the cap stack and last money in. Are you kidding? Like, you just put 7 years into building this thing. You're the last money out. You need to create real enterprise value. And so huge misalignment there. And, I would also say for the most part, when your early stage investors are investing in you, your late stage investors are investing in your company. And those are two different things.
This episode is brought to you by Propeller Industries. If you run a high growth business and you're focused on profitability, extending your runway, and improving your operational efficiency, you probably need a finance and accounting whiz that will grow with you. Well, instead of hiring someone full time, what would be cost effective is working with Propeller Industries. Propeller Industries is a leading strategic finance and accounting partner for venture stage companies and has partnered with over 1,000 startups and high growth businesses across consumer products, consumer tech, and enterprise. Some of the brands that they've worked with are Liquid Death, Olipop, Hims, Farmer's Dog, Away, MoviePass, and Giphy. Propeller also provides specialized support for fundraising and M&A with transaction advisory services. Propeller's TA team of former investment bankers and investors can step in on more of a project basis when pursuing full-scale financing and M&A. There's a link to Propeller Industries in the show notes if you want to learn more information. So obviously you've had, I think, if I'm correct, 8 seed funds. Like I think you're on fund number 8 on the seed fund size. On the select side, I believe you're on fund number 4. If that's right. So how large is like the fund 8 seed size, and how do you even think about how big of as a dollar amount, like when it comes to your strategy? We can dive in a little bit of your strategy. What like the ideal fund size is for seed?
Yeah, it's a great question. I think what you've seen over time as the sort of more and more interest has come into venture broadly is you've seen fund size get bigger and bigger and bigger. I mean, there's now people who have $500 million, $600 million seed funds. That feels really big and hard to sort of rationalize as a business model, but AUM is attractive to a manager, right? Like, assets under management means fees, means yep. And for some of these funds, it's a lot more than 2% or a little bit more than 2%. So yeah, I think what you see is there's been a drive towards larger funds. That is not that is a shared fault. LPs have been there to provide those dollars and GPs have taken the money. And it's not like GPs did something wrong or LPs did something wrong. The whole space got overheated and funds got too big. Our funds have gotten bigger sort of like incrementally fund over fund. And there's a few reasons for that. One of them is going from our first funds to where we are now, our ownership has grown. And so in the early days, we might have owned 1 or 2% of companies. Now we're owning 10% plus of companies. And so there is natural growth that comes with that. I think if you are a seed fund and you're trying to move up to own much more than 10%, you have to make some changes in your model because you can't be collaborative. Every deal that we do, we're collaborative. We're working with other groups. We're taking 10% of usually a 20 or 25% dilutive round. And so we're able to work, generally, I'd say really nicely with other funds who we think add value, who we like to work with, who founders have pre-existing relationships with, or who founders think are going to be great partners, et cetera, et cetera. And so uh, it's important for us in terms of how we source deals and how we sort of participate in the ecosystem that we are not going and trying to gobble up 15 or 20%. I think the funds that move into 15 or 20%, it feels really good because they're able to say, well, I have lots of ownership. I think that you limit the pool of companies that are ultimately going to want to work with you and the deals that you're going to see because you shut off some opportunities that are not looking for one singular partner from a founder perspective, or some deal flow from other venture funds and angel investors who, don't want to share a deal with someone who's going to try to gobble the whole round. And so, our check sizes have gone up. We now make between 40 and 50 core investments in each fund. That's a strategy that we've executed now for several funds, and we think it's a, a strong position where we have both enough variety that it's sort of the right size where any single company can be a fund returner. So we have enough shots on goal, but we don't have so many shots on goal that we end up being an index fund of sort of like, broad, like what does seed in New York look like? Yeah. And so we think we have the right mix of concentration, and it's something that we revisit every fund. We've also, over time made slight tweaks, or maybe in some situations more significant tweaks to how we think about reserves, and money for original checks versus following on. I think we've learned over time that we think follow-on capital is important for a bunch of reasons. One, we think it's important to the best founders to know that they're going to have supportive capital down the line if they do their job from insiders. I think it's an important signal in the market, and so it's something that we want to do in terms of being able to get into the best early stage deals. We also think that when we have sort of an unfair information advantage, or any insider has an unfair information advantage of understanding how a company is behaving, and so knowing if there are places that we want to put more money in and buy up is a tool that we can use. And then I do think that over time we've seen that, and we're seeing it in this cycle. 5, 6, 7, 8, 9, 10 years later, you can have really great companies take a stumble, not a huge stumble in some situations, but a stumble, need capital. And if you're one of those companies, then you take a stumble and you need capital in a market like this, the folks that are coming in to save the day are predators and are doing, I think, you know, are just really, really, really trying to take a pound of flesh, and that can be really problematic for the early stage investors who don't have late sort of reserves years down the line. And so thinking about how we are able to be defensively minded, because you never know when you write a seed check what the series B or C or D market is going to look like years down the road when those companies are raising money. And if it's a market like this one, you may find some pretty unpleasant outcomes if you're not set up with a little bit of cash.
So is follow on pro rata capital actually a good thing, especially like in today's market? Because on one hand, yes, it is like a positive signal, right? It is a positive signal that you're following on, and of course, as a seed investor, for example, looking at having future investors to be part of the company's journey, you obviously know probably the most about the company since you've been working with the company since you invested in the company in the past. But if you don't follow on, if you don't actually do it, then that is like I would think a pretty negative signal for the company. So like if does it actually, like, I understand in terms of, like, following on pro rata makes sense from, like, a return standpoint, and you want to keep that percentage. But what's your philosophy about, follow on pro rata signal overall? And also, like, how do you decide, like, what are your kind of metrics or like viewpoints in terms of deciding which portfolio companies you actually follow on versus not?
Yeah, it's a great question. It's an ongoing conversation and something that I think we and probably our peers are all cognizant of. If we look back historically, our follow-on capital has performed well. We feel like we've done a pretty good job of following on, and generally it's been we've made good investments as following, by the way, and plenty of bad ones, and that same could be said for seed. But like I would say that something that I find to be interesting is it's not clear what companies are your best companies 2 or 3 years in. It may feel like it is, but one of the benefits of doing this for a long time is we have uh, a bunch of cycles to look back at learnings. And one of the learnings is the early breakouts in a fund, your companies that 3 or 4 years in look like your best companies are not necessarily going to end up being your best companies. We've had companies that have been slow, quiet, meandering companies that eventually find it years later. We've had companies that fail and pivot and save the day. We've had companies that look like extreme breakout successes and become victims of their own success. They overraise, they get they get full of themselves and end up making all kinds of mistakes. And so um, I'd say what we're trying to do early is uh, err on the side of, if we think we like what's going on broadly and we think that the round is being done in a sober, rational, reasonable way, we want to continue to protect our investment in the early days. If we think something is a round is coming together in a way that we're uncomfortable with, we think that, by the way, there's going to be situations where a company is a good company, but we've just had a really unproductive relationship with the founder. These are few and further between. But like, these are real human relationships, and sometimes it happens. And so, I understand the signaling. I would say that generally we want to be on the side of like highly company supportive. Um, I think in any round, any investor who participates, even if they have a policy which is we do not do follow-ons, I see the investors who explicitly say we do not do follow-ons in certain situations do follow-ons. Like, I don't think that unless you're going to have a like true black and white, really firm policy that under no circumstances ever are you going to write a follow-on, there is some signaling risk. Um, the reality is this: build real companies, and you're going to have capital available to you. Don't, and you may not. And the signaling risk and all this stuff becomes in really good companies. Nobody cares what the early stage investors are doing. In fact, in really good companies, often the next round investors are trying to make sure that the early stage investors don't get their pro rata. And so, I just don't think it's as clean as we might all like it to be.
Have you had companies where you haven't exercised your pro rata that have done really, really well still?
Oh, totally. Yes, I mean, that's one of the benefits of doing this a long time. We've had companies where we passed and they ended up being awesome. We've had companies where we really ponied up and we were really excited that did less awesome, and everything in the book. I mean, we've seen it all, and so um, that's and the product of all of this experience is sort of the today's strategy, which will be incrementally different from next year's strategy. We're learning, and we're trying to be active managers, and not just like run a playbook.
So as I understand that you ideal target for each fund 40 to 50 investments. How do you think, since you all are generalists, how do you think about, types of categories or number of companies per each category? How do you even like define, specific categories to invest in? And is there kind of a, okay, we need a certain amount in for let's say like consumer brands or a certain amount here in like B2B SaaS in this particular vertical, or since AI right now is all the talk, do we need like a lot of AI companies? Like how do you think about it from like a category perspective?
So we think about it at a I'd say loose and high level. We want, as we think, we'd like vintage exposure to like the large areas of the American economy. And so, we're going to want some consumer brands generally in every fund. But again, we are chasing talent. And so if it turns out that where we think like A plus talent is right now is generally matriculating away from direct to consumer brands, we're going to have fewer of those because we're not going to force our way and say we have to do, this is a big part of our strategy. We have to make sure we do those if we're not finding the opportunities. I mean, we are proactive in finding great talent and reactive in terms of what those categories are. There are then filters, let's say. And so we think about what the world, we imagine what the future looks like. We spend a lot of time talking about what we think the world is going to look like in the future and how people are going to work and how people are going to live and how people are going to, encounter the healthcare system and how people are going to travel and, like broad areas of lifestyle. And we think about, a topic I think that we talk a lot about is the environment and, how will changes in the environment lead to, business opportunities and, and business risks. And then from there, uh, we tend to have areas that we're in a window, maybe a little bit more focused on. And then, as I would say, sort of, good deals beget good deal flow. And so, 4 or 5 years ago, we started to get interested in the energy transition, and it turns out we made a few investments, and one of them was in a company called Palmetto that in the solar space that was sort of a pretty quick breakout for us, and we got close with the CEO there, and he was an active angel in the energy transition space and knew the space really well. And um, he started to send us some stuff, and we started to send him some stuff, uh, and then we suddenly a few years later found ourselves with a few more bets, and then picked up our head and said, "Wow, we really actually have a pretty interesting portfolio of." Energy transition bets. And then when you have an interesting portfolio of bets in a category, you'll learn a lot. You spend time with these companies and your perspectives get more and more nuanced, and we're able to think about the business models and the spaces that we like more or less. And, it is like the business that we're in is people first, industry second, and company third. Uh, and I say that, where we can get messed up at seed. I mean, we can get messed up in a bunch of places, but one of the places that I think we can get most messed up is looking at, the data 2 months post launch and saying, "Oh my God, it's working perfectly. It's amazing. This is going to be a huge company. Let's go, let's go, let's go." And then sort of those are the deals where when we get totally hot and bothered by, whatever the early breakout success is, 3 months later after we make the investment, inevitably things have sort of cooled off, or whatever like weird little acquisition hack they had has stopped working, or, and we sort of are like, okay, we got tricked. And hopefully in that situation, we still think that we invested in the right founder in the right space, and then that's okay. The worst is when you go, we like talked ourselves away thinking the founder around the idea that the founder was good, but maybe not great, but it's okay because the company is great. Like we have to make sure that this is, we say this, I said this week in the partner meeting, like if it's not a hell yes, it's a no. And that is a people-based decision. We cannot do like, we like the person and we love the company. We're going to be wrong.
So how do you evaluate talent?
Look, I think early stage investing is as much or more art than science. Uh, this is, pattern recognition. I think that, when I look at our team here and the skills needed to be a great early stage investor, I think soft skills are critically important in how you assess people and how you assess someone's ability to lead and motivate. I think we're looking for people who we think have sort of unfair advantages in the spaces that they're going into. We're biasing against the like really, really nicely pedigreed Stanford or Harvard Business School person who does not have practical experience in X category, but that uh, did a really good senior project and decided that they want to go launch a category in a space. Um, and I think we bias against folks who think about starting a company as an alternative to getting a job. I don't know. I may go and join Meta as a product manager, or I may start something. It's like, like that's like so you're going to use our money to like go see if this is a thing, or you're somebody who has a personal deep passion and like there's a thing that like an itch you can't scratch and you need to go start this thing. And by the way, that doesn't mean that you can't graduate from HBS and be someone who has an itch that you can't scratch. But I think that's what we're trying to figure out is this your life's work, or is this a consulting project outcome?
Yeah, no, that's a fair point. Just because someone maybe has incredible pedigree and obviously maybe have been lured for with incredible job opportunities. Are you gonna take it, or is this something that you're actually want to build? And of course, you Ben, you're an entrepreneur yourself. You know how all in you need to be in terms of building the company, and actually have be obsessive when it comes to actually um, to actually accomplish something, because no matter what category it is, building a business is really tough.
Yeah, I building a business is really tough. Really tough. I think that the royal we, forgot that. In 2021, everybody forgot that building a business was really tough, and it is really tough. And so I think that obviously we have sort of like some of our secret sauce into the different ways that we think about talent, but like uh, there is you know like you said, I'll just use me, not like the firm, but like I've I built stuff. At various times I did a good job. At other times I did not as good a job as an operator and as a founder. And uh, you know, I've worked with and hired a ton of people over the years, and now made a few hundred investments. And like over time, you start to meet people and say, you know what, interesting. This person reminds me of this other person that I've worked with and that we've backed, and they think about the world the same way. And I look at where this worked and where it didn't. And in some ways, this is inelegant, but in other ways, it's, I think, really powerful.
Do you find, when you think about area expertise, in this example with pros, as you mentioned, you thought that their area of expertise was distribution. Um, do do you find, and I know you mentioned, like, obviously, is it supply chain, for example, marketing, for example, what's the kind of area of expertise there? Do you find that you kind of skew, like, or navigate towards one type of persona when it comes to founder? Like, do you prefer, for example, a founder that has like branding, marketing chops, and that's what they're really kind of special at, and that's kind of their superpower? Or if it's really building product and on the supply chain side, um, is there is there like a type of a founder in that kind of like persona that you prefer to back?
It's a really good question. I don't think that where I biased may be different depending on the category and the kind of company in any given situation. Um, what I would say is top 1% talent at whatever it is that you are a specialist at is important. And so if you're going to be a marketer, you better be a really, really, really freaking good marketer if that's going to be the unfair advantage of the company. And if you're going to be, I would say over the last few years, we had a little bit of a bias towards not what's on the bottle, but what's in the bottle. That's a sort of, a sort of kitschy way to say, how are we backing companies that are creating really protected IP, more efficacious product, something that stands out in the actual uh, in the physical product itself versus how the product is marketed. It's, we've done a few sort of connected hardware companies where, you know, multi-year slogs to go build a sort of a patent portfolio and create something that is really differentiated from a product perspective. Um, and eventually you're going to get to that business having to be marketed, but the real skill set of the team, at least in the early days, is going to need to be a team that knows how to go build that really, really, really difficult, piece of technology versus in a different situation where, you may find a founder who has just incredible insights about a certain demographic. I look at a company in our portfolio like Topicals, and Olamide, the founder, who understood the pain point for a specific underserved customer in this just like incredibly intuitive way. And when I met her, it was a slap across the face that you were talking to a woman who deeply, deeply understood who she was building for. And the bet we took was that she understood this woman and was going to be able to connect with her. And guess what? Correct. And she has. And in that case, like, her unfair advantage was not that she knew how to, run a supply chain and manufacture a better product. She's learned how to do that and surrounded herself with people who know how to do that. But that was not the background. The background was being an incredible community builder and marketer and connector. And I think that, we've won with companies like that, and we won with companies that are, scientists building a product. And so I don't want to say I'm looking for great marketers, find me great marketers, or I'm looking for great scientists. I'm looking for outlier talent who is going to be absolutely special at whatever that special thing is that they do.
It seems like because and you were saying on the you put it really well about we've kind of cared more about what's on the bottle rather than in the bottle. If we care more about what's in the bottle, do you think that we're starting to skew with like more towards like investing in, like, the scientists or people that are actually like more like the product side builders rather than the marketers?
We've I think if we look at our portfolio over the last few years, that's probably been the case. We have a funny situation in a stealth company in our portfolio that we invested in a long time ago that's actually not been announced yet, where we invested in scientists who were building a consumer product. And it turned out that they were so good at being scientists that the product that they're building, that that they never launched a consumer brand. And what they're building now is uh, a I would say sort of a back end to go and create unbelievably efficacious, really, really special, potentially incredibly valuable formulations. And they're probably not going to be the ones to market those products. And so, but you get on. But by the way, when we invested in them, we didn't say these are going to be great consumer marketers. We said these are going to be badass scientists who are going to make incredible stuff. And it turned out that the incredible stuff that they're making is going to be coming to market differently than we had originally envisioned. If you don't bet on people early, it's rare that you find those sorts of circumstances where you bet on why and you're wrong and you still end up being right because the people are amazing and they sort of move and find their way to the right outcome. If you're betting on a company, it's rare that you're able to sort of take advantage of the pivot. And the pivot is, I think, an important part of the business model for the seed fund.
I just kind of I'm just so curious because obviously you've been in media for a long time, with Thrillist and obviously everything with those companies. But how do you think? Obviously, there's a lot of chatter about AI and content today. How do you think about running like a content media business today? Do you think that AI will will do the majority of the writing or will be so helpful in terms of the writing side on the content that these are going to become much leaner businesses?
It's a really good question.
I'm sure you could probably talk for like an hour about this, but
I think that
anyway.
what I would say is, for lots of different kinds of content creation, AI will play a really active role. I think that there will always be a place for incredible journalistic and creative talent that maybe in the background they're using AI to, augment workflows or, help them do, various kinds of sort of rote work, but that like real creative talent will always have a place to be valuable. I think that sort of mediocre creative talent is probably going to be more disruptable in the sort of short and medium term. Um, and I don't think it's a bad thing if media businesses are able to run more efficiently because of using technology, particularly in digital media. We have not seen the business model be a great model. Uh, and so, are there winners? Yes, but there's way, way, way more losers. And so, figuring out how to do more with less, not in the spirit of being able to like eliminate tons of jobs and fire people. That may be an outcome of that in some way, shape, or form, but in the spirit of building sustainable, scalable, better businesses, using AI is going to be important, and I think is a great opportunity for digital media. Um, Look, I have little kids, and I think about this a lot, just in terms of, what are the, what's the job market going to look like, and what are their careers going to look like, and on the one hand, like I said, like, for great journalists and great talent and top 1% marketers and top 1%, like there's always going to be great opportunities. The reality is, math would say that most people aren't top 1% at anything. Uh, they're, and by the way, I'm one of those not top 1% at anything people. And so, I look at my kids and I worry about a world where extreme excellence has a place, but everything else gets, eaten by the robots. Um, I don't know what that looks like. I am both excited by and terrified of AI, um, and uh, it, the media business today at any step is tough and getting worse. It's getting worse. Like, I don't care if you're a streamer or you're a TV company or you're a podcast, like it's getting worse everywhere. And if AI can help some of these businesses get better, let's figure that out.
Yeah, that's how I kind of view it as well. I don't think that journalism or anything like that is going away. I just think that it's an opportunity to actually create leaner, more sustainable businesses on the media side, because digital media has been no one's really cracked it in terms of the code. I mean, obviously there has been winners that's true, but digital content has been really challenging and obviously very disruptive to like the old model, where the old model was very lucrative uh, across the board. Um, Ben, thank you so much for your time. It's been a lot of fun.
Mike, my pleasure. Thank you for having me.
And there you have it. It was a pleasure time with Ben. Ben, thanks again so much for coming on the podcast. If you're enjoying the show, please hit that subscribe button, whether it's on YouTube or Spotify or Apple Podcasts. And if you're really, really enjoying the show and you don't want to be left out of the loop, subscribe to the newsletter at theconsumervc.com. You'll receive all the latest funding updates each week, and you'll receive notifications on when each episode will be released or is released. Thanks for listening.